We have a very diverse panel of experts with us. We have economists, we have bond dealers, and we have a banker. And today it's the banker who's most important. Rajiv Anand, the Deputy Managing Director at Axis Bank. Rajiv, what does this CRR cut mean? Does it mean deposit rates have peaked for now?
Clearly, I think the fact that we're going to get over 1 lakh crores of liquidity into the system clearly indicates that one of the things that I've been mentioning is that overnight rates are at 6.5%. On the margin, 1 year deposit rates are anything between 7.5% to 8%. In an environment where the next move is certainly down, that gap is just too much. And I think with this CRR cut, we are going to see deposit rates come off over the next 3 months or so. So a very simple answer to the question that you're asking: have deposit rates peaked? Absolutely.
For most banks, the NIMs would rise by about 3 to 5 basis points.
I think that's a fair estimate. Remember, the impact is not going to come through in this quarter, but it will come through, from the next quarter onwards. But I think an estimate of 3 to 5 basis points is about right.
And when may lending rates go down, you think?
There is no reason for lending rates to go down at this point in time. Anyway, we've seen a significant reduction in
deposit rates have peaked.
But remember that on the corporate side, pricing is quite tight anyway, and we've seen a slowdown on the credit side over the last 3 to 4 months, and so therefore I don't expect any material move as far as lending rates are concerned. And remember that much of the book is now EBLR linked, and so therefore you should expect a material change only when the repo rate changes, which, given the expectations on inflation, look like it's been pushed out by some time.
Oh, by some time. See, that's the question now to the economists. Upasna, he said something in the end about how our policies are prudent, timely, practical. So are you reading of a rate cut in February, especially because the second quarter forecast for CPI is 4%?
Yes, Lata, as you correctly mentioned, I think there are 2-3 aspects to this. One, while RBI has revised down their estimates, they still remain on an average in the second half of the year at 7%. We see a fair amount of downside to that. Yes. And as we see incremental, more high-frequency data coming in, the RBI too will come to realize that there is downside to their own estimates. That's one. Two, of course, the second quarter inflation reading at 4% is suggestive that from henceforth, 6 months down the line, that is what RBI should be focusing on, how they are looking at inflation trajectory, and that disinflation towards the last mile is being achieved by 6 to 9 months down the line. And I think that's when we do see a window open for the February rate cut. Much will, of course, depend on how the global environment will, of course, pan out. And that is going to be playing a very important role in determining the timing. Yeah. But I think definitely the February rate cut is on the table.
Yeah, it's on the table. Of course, Jan 20th, Trump takes office. So, as you say, the governor will have one eye on the external matters, inflows, outflows, value of the dollar. But for the moment, actually, there's a bit of celebration in the rupee market as well. The rupee has moved stronger from where it began. We are now south of 84.6, moving towards 84.58, 84.57. That's quite a bit of a gain that the rupee has seen. Kaushik, first takeaways from what the governor has said, especially in terms of when you expect a cut.
So Lata, we are very happy. This is extremely prudent and practical decision because we were in favor of a CRR cut first to improve the liquidity and then do a repo rate cut at some point, which we think will be February. Because I think January-March inflation will also fall to 4% because October-December, we are going to get something like 5.5, 5.6 average. Therefore, the disinflation of vegetable prices will be very strong in January, February. So not just April, June, I think the first half of 2025, you could have a situation where inflation is at 4%. And RBI is always forward-looking. So when they come to February, after having, kind of done the CRR cut and before the sequencing of changing the stance to neutral, I think February will be a good time to start the rate cut, not because data is very poor at that point of time, but you're looking ahead in the next 2-3 quarters and taking a call. If you don't cut at that point of time, whether you'll be behind the curve. And I think February will be a good time after the budget, because we think the fiscal consolidation will continue. And therefore, you need some monetary policy support. RBI is saying 6.6, and you're pointing out that there is some downside risk to that as well. And we know that 6.5, 6.6 for India's growth is below potential. So in order to keep it at 6.5, 7 with this global, backdrop of, Trump administration, you need some monetary policy support. And I think 50 basis points rate cut over February and April will make a lot of sense. We also believe that at some point, RBI will push the short-term rates to the SDF and have an effective easing of 75 basis points in this cycle, which will help growth to remain in the 6.5-7% zone for the next few years, despite the global backdrop. So to answer your question, I think February is the best time to do the rate cut.
Okay, actually, yeah. Got it. I just want Rajiv once again. Rajiv, I think another very important announcement has been raising the ceiling on inviting NRI deposits. The ceiling was for 1 to 3 year FCNRB rate could not go above the overnight ARR rate plus 200. Now you can go up to overnight ARR rate plus 400. And likewise, from the 3 to 5 years as well, another 2 percentage points increase in the rates can be given by banks. You expect decent flows, and do you think that's why the rupee also is appreciated?
I think it's been well articulated that the RBI is running a short dollar position in the forward market, and I think it is very keen to attract dollar deposits. But I think the problem currently is that anyway FCNRB rates are well below even the old ceiling, and so therefore to that extent increasing the ceiling at this point in time I don't think will make too much of a difference. What would perhaps have worked is if for the incremental FCNRB some sort of CRR dispensation was given, that would have incentivized the banks to go down this road. But I think this increase in ceiling may not have too much of an impact.
Okay, Kanika, thank you for standing by. Quickly, your key takeaways, and the governor making two very clear statements. One, that growth in the second quarter has bottomed out. He sees an upside with that 6.6% forecast in mind. And on CPI again, after the third quarter, fourth quarter onwards, easing is expected all the way down to 4% by the second quarter. Keeping that in mind, is February your base case as well for a rate cut?
So Ritu, thanks for having me on the show. Yes, February is a base case for us as well. And we are calling for 25 basis points rate cut in Feb and April. We'll ascertain more depending upon how the growth trajectory pans out. See, it's very important to understand just two key takeaways from our side. First, even though growth is recovering in the second half, because 5.4% in Q2 itself had a base effect to it. But from an inflation standpoint, after the 5.8% spike or a higher than expected inflation number from MPC's perspective, the 4.5% growth, 4.5% inflation for the last quarter, in our view, it actually has an element of a downward surprise unless weather shocks materialize significantly. In fact, 42% vegetables inflation in October. If it squares off by March, you can see a downward surprise on inflation, which is exactly why we are calling for that rate cut in Feb. There's only one risk we want to point out too. While the governor just mentioned about global uncertainties, heightened geopolitical risks as well. But we think unless and until dollar volatility stabilizes, the shift in policy may become challenging across central banks in emerging markets, including India. So Fed is a base case, but the risk we want to watch out for is stabilization of dollar, especially after Trump takes office on 28th Jan. Thanks.
No, absolutely. The external environment is one of the key risks to watch out for, especially in January after, like you said, Donald Trump takes over as president. Shobhit, thank you again for standing by. Your quick takeaways, not much of a move again on bonds. Of course, the rupee, we've seen some improvement.
Yeah, hi. I think the key takeaway is the basically adverse growth inflation dynamic forcing RBI to wait and watch, confirm whether the decline in inflation actually happens and growth actually picks up. So I think these two are the key parameters which RBI would focus on. If indeed growth picks up and inflation comes off, and global developments post Jan 20th are not as disturbing for markets, then perhaps Feb would be live for starting the easing cycle. But in my view, especially easing cycle this time around is only 50 basis points. So perhaps if we start in Feb, the next one may not happen in April, but could be pushed out. So if we are going to see only 2 rate cuts, then the longer they are spread out, the more the benefit could happen in the markets.
All right. Rajiv, that CRR cut last we spoke, you were hoping for, that has been delivered. You said not much move on the lending front yet. Deposit rates have peaked. But what do you make of some of the other measures that have been announced, specifically on the collateral-free agriculture loan limit being raised? What sort of additional credit do you think that would unlock? What do you make of how significant the move could be?
I think they're all positive moves. It's difficult to estimate. Also, obviously, there will be more credit that is available to the agricultural sector. But I think what is more important from our perspective as well, our ability to now to meet our PSL requirements, particularly in the small and marginal farmer category, improves thanks to this. And so therefore, to that extent, this is positive for banks as well.
A lot of commentary, Rajiv, again, from the Reserve Bank of India on these mule accounts. And we've been repeatedly hearing this for the last many, many months. Is there specific directives from the RBI? Are you expecting some regulatory guidelines on this? Could there be some punitive measures in areas where RBI is seeing some issues with regards to too many mule accounts not being handled?
I think the issue, Ritu, is systemic. This is a problem that all banks are seeing of fraudsters becoming more and more innovative, being able to open accounts either physically or digitally, sit in the banking system, and then use these accounts to be able to do teaming and lading, etc. So this is a challenge that all banks are currently grappling with. We are working with the RBI and enforcement agencies to see how we can tighten our KYC norms on one side, and to be able to use technology to identify some of these mule accounts and either debit freeze them or actually shut them down as well.
Okay. Well, I guess those efforts would be on anyways between RBI and the banks. But clearly they have upped the ante on this, and this could have a lot of ramifications even for the kind of activities we see in the stock market. I want to come back to the growth story. We have to remember that the Reserve Bank said that the second quarter, the fall in growth has bottomed out, but they have sizably cut the second half forecast from 7.4 originally to 6.8. Now that's a 60 basis point cut in their current quarter forecast. So they have not, the positivity in the third quarter also is not that gung-ho. And then they go on to 7.2, which some may consider ambitious. Upasna, ambitious, you think?
Lata, I'll take it like a H2 versus a H1. And I mean, yes, as you mentioned, the quarterly profiling. But if I go by what RBI's estimates are, at 6.6%, the second half of the year is at 7%. Compared to a 6%, compared to a 6% in the backdrop of a 8.2% average last year.
Correct.
So I think that is something which, if you look at, I see a significant downside. Yes, they have revised down significantly their third quarter estimates, but I believe there's further downside to these numbers. I think overall the headline GDP for the full year would be somewhere, we are at 6.1%. With a little bit of, anywhere in between 6 to 6.3% is our range. So I think there is significant amount of downside further to RBI's estimates currently.
Yeah. I mean, we should not have celebrated the 8.2 of last year, because that was a large bit of net taxes which were adding to the GDP. We should have concentrated on the GVA. And even then, the GVA for the last 2 quarters in the previous year were fairly strong. So we are struggling with a big base, even for the current Q4. And therefore, 7.2 could be a slightly ambitious number, especially given the headwinds on the external account, more in terms of uncertainty. Though economies are resilient, there is uncertainty as far as the 4th quarter is concerned, when the new government is sworn in the United States. Kanika, now very rapidly, I want both the economists also to comment on the growth number. What would your number be? You think 6.8, 7.2 is ambitious?
So Lata, for second half, we are at around 6.7, 6.8. 7% plus growth number looks difficult, which they've penciled in for the last quarter, given weak credit impulse. And as you talked about, global uncertainty means broad-based private capex recovery is missing. Yes, agri will surprise you on the upside. You can get a 4 to 5% handle there, and government spending pickup will support. But it may not be adequate enough to give a 7% plus growth number, which is why growth is a concern, needs policy stimulus. In fact, we think it should be a combination of fiscal and monetary stimulus.
I just want a brief answer. Okay, Kanika, got it. We have to be brief now. We have to wind up. Kaushik, what's your second half?
Yeah, we have something like 6.8, 6.9. We haven't changed, and our full year forecast is 6.5. Remember that in February, when the data comes out for October, December, it will come out with a lot of revisions of the past data. So it's very possible that FY24, the 8.2% number that you got will be revised down, towards 8%, and suddenly second half might look much better, even if it is statistical.
Yeah. Okay. Yeah. I mean, those are of course imponderables which the Reserve Bank can't work into its model. But even after having brought down its forecast to 6.6, all the 3 economists over here believe it is perhaps still an ambitious number. That tells you something about the pace of the economy. Finally, Shobhit, I wanted to ask you, now that this liquidity is coming in, will CP/CD rates start falling?
Yes, I think because of tight liquidity, there was some upward pressure on the extreme short-end yields. They would be easing. We saw a lot of issuance by banks of CDs recently. And I think there would be definitely some easing on the short end. 3 months to 6 months money market yields would definitely improve from here on.
Okay. Well, gentlemen, thank you very much. Actually, ladies and gentlemen, thank you very much indeed for joining us on this special monetary policy show. The policy has lived up to its importance and the cruciality that it was invested in. A very important CRR cut coming in after 3 or 4 years after it was hiked from 4 to 4.5. It's kind of coming back to status quo ante, and that's going to release 1.16 lakh crore. Exactly what it means is 1.16 lakh crore of the total 230 lakh crore deposits was kept idle. You could not lend it. Now banks can lend it. So that means they will not die for deposits. They will not have to raise deposit rates to attract longer term deposits. Therefore, we can see a bit of a peaking off of deposit rates. For those of us who are savers, that may even be bad news. But for the bankers, it's definitely good. And that's why we are seeing this dramatic jump in the bank nifty and of course in the nifty as well. But the U-turn has really come in the bank nifty. On growth, the Reserve Bank has been much more modest than what it was on October 9th. But there can be a feeling that even 6.6 could be slightly difficult given the kind of slowdown we saw in the second quarter. That's the coverage on the monetary policy coming to you straight from Mint Street. Over to you, Ritu.
Well, thank you, Lata, for summarizing that for us. On that note,
for more news and updates, all you need to do is follow CNBC TV 18 on all of our digital platforms.